Yeah, I think in terms of emerging market outflows, probably the worst hit markets in the MENA region would be the benchmark countries. So these are Qatar, UAE, and Egypt. Kuwait and Saudi Arabia, on the other hand, are still off benchmark. So I think that's a good thing. So if you want a safe haven and a pegged currency in the current environment in emerging markets, I think Kuwait and Saudi are probably the best places to be. And I think these are the two markets that are outperforming the rest of the region so far this year.
And of course, Kuwait is going to get that review in September about FTSE inclusion. But talk to me a little bit about what's happening in Dubai right now. We've seen Dubai performing at a pretty low ebb. And is that off the back of all of these revelations about Abraj and how many of these companies that are listed on the Dubai exchange, for example, are exposed?
Yeah, I think, probably the Abraj situation has impacted sentiment, not so much directly related to the performance we're seeing in the Dubai market, because the weakness has been there from the start of the year. I think it's the fact that Dubai is the most diversified economy in the region. It is a global hub, so technically speaking, it is impacted by all the talks of trade wars, because you have Dubai Ports World, which is the largest ports operator in the world, listed. Its airport is obviously impacted by any reduction in global growth and global travel. So Dubai is more exposed to probably what you're seeing in the rest of emerging markets. In addition to that, you have the element of Saudi Arabia opening up and probably attracting some of the money that's already invested in Dubai, which traditionally has been the most owned market in the region.
Mohamad, that being said, when you look at the degree, to the extent that Dubai has underperformed the broader region, at what point does this become a buying opportunity, if ever?
To be honest, I think on the valuation right now, we're talking about 7 times earnings, 6% dividend yield, which is effectively a dollar yield because the currency is pegged. I don't think you can see those valuations anywhere else in the world at the moment among the major markets. The problem is that there's no catalyst. So you might be sitting at these valuations for a while, which is why we have a neutral recommendation on the UAE markets. But if you're a long-term investor with a 3 to 5 year view, I think Dubai is a no-brainer, absolutely. Some of the banks and the real estate companies there are trading at valuations that we saw when oil was at $27 a barrel. So I think it's definitely not justified, but the lack of catalyst is probably keeping some investors at bay at the moment.
And Mohamad, when you talk about those markets that have benefited as a result of emerging market status here, what's going to happen if we see more fears around emerging markets broadly because of the macro fundamentals? I think most prominently of what's going on at the Federal Reserve, rate hike fears that could really cause a taper tantrum once again. Will we see some selling just a result of what happens in emerging markets more broadly?
I think one interesting point is that probably the GCC countries are unique in the sense that their currencies are pegged to the dollar, so the central banks there tend to move with the Fed. And if you're looking to benefit from rising US rates, regional banks, specifically Saudi banks, are probably one of the best places to be. So if you look at earnings growth for Saudi banks this year, they've been very strong, even though loan growth has been very weak, and that's partly because of margin expansion on the back of higher interest rates. So I think the GCC region specifically and the MENA region in general, they tend to benefit from stronger dollar, higher rates, and the fact that they also have the oil prices ticking higher. So if you want to hide somewhere in the emerging markets in the current environment, I think GCC is probably one of the best regions to be in.
Is it your expectation then that oil prices will continue to tick higher from here?
Yeah, I think we see, over the next 12 months, you probably see oil between $80 to $85 a barrel. I think there is a lot of risk on the supply side. Your story mentioned Iraq. There is potentially Venezuela as well. I think the only variable that we have to keep an eye on amidst the trade wars is probably the demand side, which I don't think a lot of people are talking about. So if you see global demand slowing down, then we might have to worry about that aspect. But I think for now, definitely the risks are for higher oil prices continuing for longer.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.